I think we're going to go to 220. And the reason for that is, as you know, I'm pretty bearish about inflation for all sorts of reasons coming back. And number two is I think we have really unfinanceable budget deficits in pretty well all the major economies in the world. But the US is the one where it is most likely to affect yields more than other places. So I don't think we're over. We're not done yet.
What you're writing about just a couple of weeks ago, right? I mean, yields, if you can imagine them, they're sort of like a needle on a dial in a nuclear reactor, which is telling you that the core is starting to overheat, and we are going to be approaching meltdown very soon. So you better get out of that place. You are specifically calling not just the overheating because of all the fiscal monetary policy laid on, but ironically, because of vaccination and opening back up and normalization, et cetera, there's going to be demand is a good thing. Too much demand may not necessarily be so. That's what you're calling for. And this could trigger a 2-year equity bear market. Why so specific, though? Why 2 years?
Well, first of all, you've got to say something to get people's attention, which you actually happen to think is true, but is fairly dramatic. The reasons are simple. Number one is the extra demand will come from the fact that as you open up, and this is going to take a little bit of time because so far the countries with low vaccine rates are actually not in a position where they can open up because the disease is still getting worse. But as you open up, people are going to spend all those savings they set aside as precautionary savings during COVID because they didn't know where the world was going. That comes into the market. In addition, you have these huge stimulus packages from governments and from central banks. Take the US alone, you're looking at between an additional 8 and 9% of GDP plus another $2 trillion for infrastructure spread over time. So you're asking an economy which is highly mature to actually grow at a rate of 6 to 8%. Well, that's like asking an octogenarian to jive. It may be, in many respects, a sympathetic idea, but it is rather unseemly. And the result of that will be stress. And stress will mean all sorts of things. But the first thing it means is you do get inflation because you're growing above the sustainable rate. And as a result of that, you get higher yields. And this is not a good scenario for emerging markets because effectively, if you look even today, you will see the short-term yields, like in advanced economies, are not moving, but the long-term yields are moving up very sharply. Now, what that affects is, and what it reflects and affects, is their ability to raise external capital. Last year, they didn't need any external capital because their current accounts were in surplus because the domestic economies collapsed and their savings rates went up. But as they recover, those external balances will grow and they need funding. And that's going to be increasingly difficult in a world in which bond yields are going to really continue to move up. Now, why is it a 2-year bear market? It's very simple. It's because we've reached a tipping point on policy. And I think markets will very soon see that more stimulus is actually a bad thing. It creates unsustainable imbalances in government financing and unsustainable balance sheets for central banks. So the tipping point on policy is what actually means that the governments and the administrations and the central banks do not have the tools to fight a bear market when it happens.